Welcome back, everybody, to the 50-day property challenge. This is the second part of our legal discussion and how all the legal aspects are put together with regard to property investment. Again, we have Matt L. and Jared with us, and today Maya Deval, who's our attorney specialist in Cape Town. So today we're going to talk about specifically structures. After we spoke about offers to purchase earlier today, we're now going to talk about structures. Maya is going to talk about how and what type of structures you can use to purchase property. Because Jared is a first-time home buyer, we are going to talk to him about how to structure his portfolio. We're going to first talk about if you only want to buy one property and what type of structure is best for you then. Then we'll talk about Jared, who wants to buy his first property but expand into a portfolio and what options there are for him. And then also for Matt L, who actually has two properties already, and what best options there are for her. So Maya, over to you.
Thank you very much, and welcome everybody here today. I'm going to start first with the structural reason. Why do we do estate planning and structures and all that stuff? And this morning I actually had one of the clients here, and we were going through, and I would break it up in basically 3 portfolios. One doesn't need to go too complicated. So for example, you will either own a property in your own name, and if you are married income into your property, then obviously your spouse will automatically own the other half of that property. We also do find that if you owned the property before you got married, and thereafter you got married income into your property, just by means of this marriage income into your property, your spouse will automatically own 1/2 share of that particular property. And the day that you die or that you get divorced, your spouse will still be entitled to that 1/2 share, although they never registered the 1/2 share of that property into the deeds office on their own name. So therefore, we start looking at structures and how do I want to own my property? Is it in my own name with my spouse, or I'm married in or out of community of property, or unmarried? And the structure that I normally look at goes all about risk planning. Now, risk planning goes about, if something happens to me, what will happen to my property? For example, if I die, if I go insolvent, if somebody starts threatening me for debt, there are so many aspects that will happen. I worked out that if you die, your estate goes through the winding up process of reporting the estate to the Master of High Court, and it takes about 9 months to maybe double that to wind up the estate. And the problem of that lies is that you've got to pay an executor a fee to administer your estate. Well, not you, your estate is going to pay that money because you're not there anymore. And that fee can be up to 3.5% plus VAT. Now you've got to transfer the property to your beneficiaries. There's legal fees involved in that. If your estate is bigger than 3.5 million rand, the first 20% of that exceeds 3.5 million rand will be taxed by the government as an estate duty. Then on top of that, there's also capital gains tax. So death and dying can actually be quite expensive because you've got to pay a lot of professional fees. You've got a lot of pay transfer duties, not transfer duties, that one at least is exempt, but you've got to pay capital gains tax and estate duty and all of these taxes. So the next one is what happens in the case of divorce, debt, and we actually were laughing this morning. It came down to all these problem areas, starts with a D, death, debt, and divorce. And these are the main problems that can happen in your life. And obviously all the taxes that also come in there once you buy and sell, and also on death. So what I'm looking at normally to look at, let's consider your personal estate, then look at a trust, normally an inter vivos trust, which means a trust that you create while between inter vivos, living people, and then you also have a company structure. Now, where we've got to look at the different types of ownership. I've owned quite a lot of property and still own property, and most of them, I would say all of them, are held on a trust. Because in the days when I acquired my property, it was easy to finance, and it was also a good structure for me. For example, now that I've got 3 children, and through time, the properties were paid off. And what I did then, I appointed one of my children for Trust A. My daughter became the trustee there. And Trust B, my other daughter became the trustee there. And Trust C, my son became the trustee there. And I help them to guide them in starting to take over the responsibilities of a property by looking after the maintenance, also finding tenants. And in time, they will be able to enjoy the benefit, because they're also beneficiaries in the trust, of the income that goes to the trust. So if I die one day, my wife dies one day, those assets will not be pulled into our estate for estate duty purposes, and automatically our children will just continue without any hiccup to actually continue to manage the trust, receive the income, and also be the beneficiary in their own capacity in that trust. So what I've done there is to split the portfolio in such a way that I don't need to transfer the property to them on my death or the death of my wife. And even now, I can actually hand over the reins of that trust to them. The other alternative would be to set up a company, a P2Y, a private limited company. But again, in that company, you must have shareholders. Now, if you keep the shareholding on your own name, you've actually defeated the entire purpose of estate planning, because the shares of that company will fall right back into your own pocket or your balance sheet. So it means that the day that you die, somebody just goes and value your company, and they say that the company portfolio is 10 million rand because you've paid up all your bonds, it generates income, and that 10 million rand will slap bang back into your personal estate. So coming back to the structure, I would say we prefer at this stage to actually set company to buy property in a company, and then that company will be owned by your family trust, definitely not in your personal name. In the past, we used to do more property owning in a trust, but then came Section 7 of the Income Tax Act, which says that if you make a loan to a trust to buy a property, for example, then that will be subject to income tax as determined by the receiver of revenue, and that income tax will be on the interest that you ought to charge on a loan account. So we recommend nowadays to set up a company, and the shares of a company is then held by a trust. It also means that the income tax that you actually generate by, let's say you rent out the property, a company pays a flat rate of 28%, and the trust pays 45% on a flat rate. So it means that if you earn income and you want to retain the income in the trust, it's actually very expensive, because whatever you earn, 45% first goes to the receiver, and the rest that stays behind, the 55%, that can stay in the trust to build up the kitty of the trust. However, if you put if your property is owned by a company, then the company tax is only 28%. Now, obviously, if you start distributing the money, then there's dividend tax and all kinds of taxes payable by distributing the shares of the income to the shareholders. But you've got to go and do a very good calculation in respect of the taxes that will be applicable, in respect of distribution taxes, and also in respect of the income tax that's applicable in respect of a particular property. So I'm not going to go too much into the taxes. One of the biggest problems that you do have is when you buy property on a name of another entity, as we had the question from Tabaleng earlier, is to say, how do I finance this transaction? And I would recommend, Jared, if I look at a first-time buyer scenario, I would look at the buyer and say, okay, how much do you want to pay for property? Do you want to start out a portfolio as a first-time buyer? And definitely, if you're a first-time buyer, look at, if you earn under 22,000 Rand, I would say buy the property on your own name. The reason for that, it's very easy to raise finance. You're not going to have a huge song and dance with a bank to get property finance if you are employed by somebody. And even if you are self-employed, and if you have prepared your application in a proper manner, the bank ought to give you property finance. Now, the biggest benefit that if you earn under 22,000 Rand is that you can get a government subsidy called FLISP, F-L-I-S-P. And as the example I earlier raised, that if you earn 15,000 Rand, that's an amount I can remember, you can get up to 63,000 Rand subsidy from the government. Oh, this is an amazing subsidy. If you go to the bank and you put down a 63,000 Rand deposit on a property of 600 or 700,000 that you buy, the bank will love you. They will give you a better home loan rate. They'll get you, a deal will be approved much easier because you're not applying for 100% bond. A lot of people come to us and say they want to buy the property in a structure because they've attended a course, and this course tells them there's only one way. You put it in a company, you put it in a trust, and you build a portfolio. And I say to even Nigel, we had some of your students coming to as well, and I said to them, fantastic the structures that I teach and other people teach at the courses of Nigel, but don't be kind of with blinkers on to say, I only want to use a trust or a company. I'm not going to buy my own name because of the risk. Remember that once you buy a property, the first 5, 6, 7 years, there's actually very little risk in the property because you owe such a lot of money to the bank. And there's a little bit of capital appreciation that comes, but it's added up. And one day when you sell your property, maybe, or you retain it, let's say if you sell your property, you get the benefit of get the capital gains exemption if your profit is under 2 million rand. As I said, it's easier to get property finance when you buy property in your own name. The bank will most give you a better interest rate. And definitely, if you do buy a property on a company or a trust, the bank will ask you for a deposit. So it's very unlikely to get a 100% home loan, particularly if your first property for a property that you buy on a company or a trust. So I would strongly recommend, unless you've got very good reasons where you're saying, I never want to own a property on my own name for risk and all these types of problems that can happen, I would definitely recommend to strongly look at buying a property on your own name for your first property, depending on the value of a property and how you want to finance, because you've got all these benefits of the subsidies and the improved home loans and all that stuff. Then you've got to make sure that, obviously, also one of the things you've got to do is to prepare a will that sets up your structure, what will happen the day that you die. Because again, if you don't have a will, your inheritance will float up and distributed according to the laws of interstate succession. Make sure that you have insurance on your life and on the debt, that if you die, that your debt is fully paid up, because you don't want your heirs to inherit the debt of the property as well. Or maybe they say, this property doesn't have enough cash flow, or I don't want to take over property, let's rather sell it. And when you sell it in unfavorable market conditions, and then you actually lose out. So look at your insurance, look at your will, the way that you structure your property finance. But in general, feeling would be, first consider your own name if you buy your own property. Then thereafter, you can say, I'm now building up a property portfolio. And don't wait too long, because we heard earlier that if you buy and sell, if you buy a property, you have to pay legal fees. You've got to pay the receipt of revenue transit duty. Maybe you have to pay VAT if it's a VATable transaction, but let's just focus on transit duty. So if your property is worth more than R1 million, you've got to pay 8% transit duty on the money, and it even goes up higher if your property becomes more expensive. So try to avoid all these costs by moving a property from your own name to a trust or a company. Rather decide on the structure in advance, that when you paid, you only paid once. Now you start looking, say, I want to buy my second property. I want to buy my third property. So you can consider, a lot of people actually say, always continue to rent, because you can find a very nice place and pay nominal rent, and rather buy an investment property that you rent out. And you get your tenant, as you are doing now, as you get a tenant to pay off the bond of your landlord. So it depends on how you want to structure. Do you want to buy in your own house first and maybe buy something smaller, and then you step up? Now there's a school of thought to say you can refinance that property again. And some people actually go through these structures where we say you buy your first property, you own it for a while, and let's say you decide to rent it out. Now that rental income, let's use R1 million as an example. On R1 million, your home loan is going to be 9,000 rand. You're going to pay rates and taxes and levies of 1,500. So your repayment is, let's say, 10,500 rand. You generate, every month you generate maybe 7,000 rand, maybe 8,000 rand. Now, if you buy an investment property, you always look for properties that are cash flow positive from day one. But sometimes you don't find this property and you like the property. So sometimes you buy the property with your heart. And most often when you buy an investment property, you buy it with a spreadsheet. You go and work out, what is my return on my investment? It might be the ugliest area where you buy, but you know there's a fantastic return on investment. I've owned properties close to UCT, where there would be a fantastic return on investment, because students pay big bucks for student accommodation. And the property values, interesting enough, got stuck for about 5 years, where I thought, wow, I bought you a property, the value doesn't go up. All of a sudden, then one owner finds where we would always look at the million rand value. One owner sells his apartment for 1.5. That immediately sets a benchmark. We call it the CMA, the comparative market analysis for the area or for the block. And I was able to sell 2 of those apartments where I previously thought it's 1.1, 1 million rand. I was able to sell for 1.4 and 1.5. So other sales also trigger value. And then, but I could see there that I reached my saturation point in rental income. It's also got to the point where I got fed up with students because they break stuff. They always lock themselves out and all that stuff. So then I moved the investment to something else. So also, I always say property must work for you. Never get stuck with a property and be too precious about the property. Let the property work for you. Sometimes you sell that property, you use that money to buy another opportunity. And I'm sitting with another client now that in Somerset West, he bought a property for 7 years. He's not even on break even. Now that's a bad investment. He's struggling to find decent tenants there because he also bought on a concept where somebody told him, you buy a property, you gear it. You buy a second property, you gear that first property. And he's still struggling with his first property where he doesn't even make enough money to pay the levy and the rates and taxes and pay his bond. That's a bad investment. So always look around for that. I've dealt with another gentleman that presented property TV seminars. I was sometimes one of his guests on that. And he told me that what he does, he goes for a month or 2 or 3. And every Saturday, every Sunday, he checks out the property listings. He goes to the open show houses. He became an expert on the concept of a 2-bedroom apartment in this area. If you pay 700,000 rand, it's too expensive. So he was waiting. Eventually, he bought apartments that normally go for 700. He bought it for 550. Immediately, his bond repayment is a lot less. He could put in tenants there because he understood the market. He would go to Property 24 and he would look at if people are renting out properties in this area, what type of revenue return do I get on that? And then he worked out that if he buys those, he actually bought 2 properties then, and both of those properties were cash flow friendly. And it was not expensive. It was 550,000 rand. I would not go out and buy a 2.5 or a 500 rand property. I would rather invest it in smaller properties. It's a lot more admin to manage 5 properties. But if one apartment goes empty of 800,000 rand, it's much easier to find a tenant for that pays you 8,000 rand a month, that finds a tenant that needs to pay you 50,000 rand. So also diversify your portfolio and separate and split it and see that it's close and easy to manage. Don't buy one in Cape Town, one in Joburg, one in Durban, and one in Fish Hoek or whatever, because it's difficult to manage. Then you've got to rely on a property agent to manage your property. Now, what does the agent do? They find you a tenant. The tenant pays them rental every month. What do? They charge you 10% rental fee for that. If a tenant doesn't pay, they just let you know that it's now the 10th of the month, or the 12th, or the 15th, and the tenant didn't pay. Now you've got to trigger the thing to start legal action. So my recommendation is that actually run your own property management because you save 10%. You are here as a money-making machine. You're not there to make the estate agents employ them. Go and do your own pre-checking of your tenants. Go and put it on Property 24, private property. Go and show the property yourself. Interview your tenant yourself, that you learn to understand and know your tenant. Because your tenant wants it, your tenant's in there and they don't pay, it's extremely difficult to get them out. So it's so critical that you actually take charge of your portfolio, manage your portfolio well, and then you know that you've got a good tenant in, because a good tenant pays off your home loan. If you don't have a good tenant, you all have to chip in, you've got to pay in money all the time. So those are my tips and recommendations in respect of investment property. And it depends if you want to live in the property, then most likely people buy on a different mindset because they look at location, they look at nice amenities, they look at nice living opportunity compared to a residential where you say, I can put in 3 or 4 people in there, they can pay me this return, I can manage them. I need to check out in before if a tenant has got a good history. There you go to TPN, you do your telephone calls, you phone the landlords and find out if this tenant can actually pay. So that's the recommendations from my side. And again, as I say, we touch on your own name, we touch on a company or a trust, and it all depends on how you start building your portfolio. Definitely, as you grow your portfolio, you would look at owning the properties on a trust, but my preference would be to own it on the P2Y, maybe more than one company, but the shareholding can be held by one family trust or more trusts. It also depends on how you gear your property. Maybe you go out for 100% gearing in the initial stages, because when you get a home loan, you put in less cash of yourself, because cash flush is always better. So if you can get 100% home loan, go for it. But consider the interest rate that the bank will charge you. Do they charge you prime, prime plus 1, prime plus 2? I worked out if a bank charges you prime plus 2, it will cost you 52% more for your property over that period of time when you pay it off over 20 years. So if you do have a home loan with a high interest rate, try to put this extra money into the home loan that you can bring down the term of your home loan. My recommendation is also go to the bank 3, 4, 5 years later and say, I have a property that I took up finance from you. When you gave me the home loan, it was my early days. You charged me prime plus 2, prime plus 1. Can I renegotiate my interest rate? The banks trick you and let you sleep there like Rip from Winkle. You sleep there for 15, 20 years while you pay off your bond of prime plus 1, prime plus 2. But you don't realize I can actually renegotiate my interest rate. But the bank don't tell you. If you go and buy a car, and as your value of your car decreases, your insurance company will actually notify you, if you've got a good insurance company, that the value of your car has decreased, and therefore I'm going to adjust your premiums. In the house, it's the opposite. The value of your property goes up, but your home loan stays at prime plus 1 or prime plus 2. The bank ought to come back to you and say that you've been paying your bond for 5 years now, the property value has increased. Can I reduce your home loan? But no, they tell you, because they've got you trapped in your home loan and you don't realize. And I often see that you can even switch your home loan to a different bank, renegotiate a better interest rate, and save hundreds and thousands of rands. So those are my tips and information on property finance, on structures. And Jared and Tabaleng, do you have any questions from your side?
No questions.
So Jared, let's have an actual discussion on are you looking to buy a property?
Yes, I am.
So how would you go out to work out the budget? Have you done some calculations? And will it be a living or will it be to rent out?
It will be to rent out. I haven't done proper calculations just yet. I just about got the app that was mentioned yesterday to check out my credit score, all those kind of things, just to get an understanding of where I am. But I do know sort of my expenses, monthly expenses, those kind of things I do know. But just to kind of make sure I understand what the affordability is for me, I have to go into the bank or call them just to check what would be suited for me. You know, in my income, I'm an artist, I'm a musician. I've got to take into account that my income fluctuates, and so I need to understand what that means for someone like myself, who's self-employed. I've got my own company, JBR Productions, and I have, since you've mentioned being able to purchase through the company, I have thought about that as well. So it's just about weighing it up and seeing what's going to be beneficial for me, what I can actually afford.
Okay.
So I end up shooting myself in the foot.
Let's step back one thing. A lot of people think that, you know what, I'm going to buy the property in my company because it does have an income. Yeah. So we often make the mistake, and I'm also one of them, that if you run your own business, you try to, Nigel, maybe just mute this for receiver of revenue, but no, I'm just joking. So if you run your own business, you kind of try to put a lot of expenses through from your personal expenses and stuff that you pay less tax. And the biggest problem that you have is that you don't pay yourself a salary.
Mm-hmm.
You actually ought to pay yourself a salary at the beginning of a month, first thing, because that money drops into your payslip, your bank account, and the bank loves it when they see that you are treated like an employed person that works at a big company or whatever. Mm-hmm. You get a salary every month. If your company runs short at any time of a month, you can always loan money back to your company, and then you create a loan account. So the nice thing about a loan account, one day when your company makes a lot of money again, it pays back your loan account, and that repayment is free of income tax. Because remember, it's just a loan that you made to the company. So I would recommend, as a self-employed musician, pay yourself on the first of every month a salary out of a cash flow, hopefully that's in the business. And you keep that regular.
So
even
give it like sort of for the next 6 months so that it reflects.
exactly.
Cool.
Exactly. So as I said, you can even lend money back to your company just for cash flow. Maybe you've got to travel to a gig, or you've got to have some expenses. So now you build up a profile. And interesting enough, that some of the banks have actually started to recognize, which is an amazing opportunity. They started to recognize that you are taking a salary out of your business every month, because otherwise you live out of your business, and there's a confusion between what your business does and what your personal life is. So separate the two. You may then end up paying income tax on that income that you have, but again, you've got to sacrifice somewhere a little bit that, okay, I'm going to pay income tax, but I need to build up, number one, a good credit score. And one of my team members here, Anele, he helped a lady a year ago. She came to us. She had a judgment against the name. And 2 weeks ago, she got a home loan and she bought a property of 649. And when she spoke to Anela, she said that she started shaking. She was so excited that now, 1 year later, and we helped and guided her and coached her how to get that thing off your name, how to then improve your credit score. It doesn't happen overnight. So even if your credit score is not on top of the world, look at that and see, how can I improve it? Number one, pay your accounts on time. Don't fill your cup with debt and all that stuff. So, but it's a time process. My daughter on the other side, she started working as a new student, and I helped her to build up a credit score by guiding her what to do. Within 3 months, she had a credit score. She was able to qualify for a loan with a bank, and she bought a property of about 900,000 rand. Now, again, this is like, wow, this is, if one can do things like this, it gives me such a lot of satisfaction to help a person look at your credit score, start taking the steps to build it up. But now it's no use that you build only the credit score, you've got to build up in your income as well. And that's why if you work for a employer, it's easy, you've got a pay slip. But if you work for yourself, start building your stuff. Now you also look at having your business, have financials for your business, having month-to-month statements. So I would rather not go to your own bank. I would rather go to a bond originator that can help you to work for that. Because funny enough is that a bank, you've got maybe a personal banker, and they maybe can guide you to the home loans department, but one needs to shop around. I've often seen that your own bank declines your application. A second bank declines your application. The third bank approves your application. You say, how come? I've been loyal to this bank for 15 years. They know my ins and outs, but they don't want to give me a home loan. So don't rely only on one bank. First, go to your own bank and see what they can give you. But then you go to originator and they see what you can do. So now, if you're working on your income, I would suggest that we get you a specialist in, and that specialist can work through your information. If you are working for a fixed salary, you'll be easily able to get a pre-qualification certificate and say, Jared, you can qualify for 900 or 1 million rand. If you earn under 22, you've got a financial dependent, we add a FLISP on top of that. So that adds and boosts your purchase power. So I would recommend looking at all those things, but definitely get your ducks in a row so that you start. And then the third one is to become an expert. Start looking around in the market. 2 components. What can you buy for your budget? And don't push your budget to the max. Buy in here that there's still breathing space there in case the interest rate goes up, or you don't, your tenant, your place stands empty for a month, and you look at, you want to buy for 600. Now you look and see, in this, it's a 2-bedroom, it's got parking, no parking. What can I rent it out for? Now you jump to property 24 in the rental space, and you start comparing what of apartments or houses, what are being rented out. So you start building up, but you actually build up such a good knowledge that when you're walking to a 2-bedroom or 1-bedroom, you can immediately say, somebody will pay me X amount of money for this. I can buy it because I can then fund it through the rental. but still your
Mhm.
own income needs to be strong enough. And also, like a tip between the four of us here is when you apply, tell the bank you're going to live in the place yourself.
Okay.
You know why? Because otherwise they're going to subtract your rental and they're going to subtract your bond. You've got two expenses per month, and they'll only add about 30 or 40 or maybe even 50% of your rental income towards your bond repayment. So you'll have two expenses, but only your own income plus a half of your rental, or maybe no rental. So if you buy a property, I'm buying it to live in. Don't go with a big thing. I'm an investor. I'm renting out. You can do that with your third and your second and fourth property. But for your first property,
Okay.
you buy it to live in yourself, because otherwise you are penalized with the rent that you're still paying. But also take a realistic look at that. Don't bullshit your application, and make sure that you've got a realistic view on your income and your expenses, that if your tenant moves out, that you can still pay the bond repayment every month. So that is your default. You must always be able to carry it for at least 2 or 3 months while you are looking for a new tenant.
Yeah. Especially
Guys, can I just interject for a minute here? There are one or two things that I sort of just percolating in my head. So the first thing is in terms of the searching for properties that we've spoken about, doing comparatives and so on. The private property app is actually quite nice to use. And Jared, we spoke earlier a couple of days ago about that. With regard to the bond origination and so on, yesterday when we had that conversation with Miguel, there lots of nice nuggets came out of that conversation in terms of how to look at your affordability using the ABSA website. There are other websites that we can use, the private property website. We can use a whole host of other banks' websites and so on to do our affordability checks, look at how much we can afford to buy, what we need to pay, etc. That was a nice tip that Maya gave you in terms of if it's your first property, maybe making sure that you tell the bank that it's your first home and you're going to live in it, because if that is the case, there are benefits to that, and especially in terms of affordability. And then in terms of the structure, being able to put the right structure in place. Whenever we buy property or we want to build a portfolio, one of the key things I always recommend is to make sure that you get the team around you that's going to advise you, your tax guys, your financing guys, your legal guys. And as you know, EDPF and the Academy offers you that structure where you can utilize all the professionals in order to make an informed decision, to not go out there and just do something willy-nilly because somebody recommended that. Rather, make sure that as you sit with your professionals, your team, to say, this is what I want to do. What do you recommend? How do you recommend I structure, so that you don't just flail around in the dark, that you make an informed decision when you decide the structure that you want to purchase in. Okay, sorry, Maya, that's all I wanted to say for now.
Yes, so indeed. So Jared, you got any more questions? Or as I say, ABSA is really giving you a good opportunity there. And then we've also developed our own My Bond Fitness platform. So there's, you can also do your credit check. One of the biggest bond originators are using our platform, and they send something like 9,000 people per month with us. And we actually just launched another version. So there's quite a lot of nice online opportunities that you can use to go through all these platforms to check. Because the main thing is just before you go out and make an offer, or even start looking around for property, go out and find what is the amount of home loan property finance I can raise. How much deposit do I have? How much money do I have for legal fees? Because that all comes down to almost like hidden costs. That if you buy from a property developer, then those costs are often included in the purchase price. If you buy from a private seller, then you've got to pay on top of that your legal, transfer, and bond registration fees. They are normally not included in the purchase price. And funny enough, the banks don't like it when the seller includes the transfer fees and the bond fees. They allow it when a developer sells the property with your fees. So where does it come in? Why do they kind of differentiate between private seller and a developer. So but anyway, these are the rules of the property finance that we've got to abide with and work with.
Understood. Understood.
All right, so Jared, I think you've got quite a bit to go on now in terms of starting your portfolio. So let's talk to Matt L a little bit. She's got 2 properties already. Matt L, do you want to give us an idea of what you have and how it's owned, and then how Maya can maybe guide you in terms of the next steps for building your portfolio?
Okay, cool. So how I bought the first one was, they're both under my own name. The first one I had, like Maya advised, tried to build up a solid credit score over some time, and then obviously I had proof of income that was quite consistent. So even with that one, I approached the bank as though I was gonna live in it. I don't know where I got that advice from, but I did that. And then with the second one, I then presented it as a investment property. So I think I actually used some of the spreadsheets of rental income from the first one as part of my affordability to the bank for the second one, because that was positioned more as a investment property. But I think now for me, because I already have 2 under my name and my life has changed quite drastically from that point where I was, in corporate, very solid structure of income, pay slips, everything was there. But now, having moved into the entertainment space where most of the time I'm working as an independent contractor, I don't know, I'm really looking to now invest property in company or trust. So it's how do I then navigate that?
My view is the problem lies with us. I think all 4 of us are self-employed. And the structure that you need to go to the bank is, as I said to Jared earlier, start paying yourself a salary, because that is what the banks are liking. And interesting enough is that the banks are also coming to the party and saying, if you pay yourself a regular salary over the last so many months, can't remember the duration, but let's work on 6 months. If you do pay yourself, I can see that your business is sustainable, because they realize they're shutting out a huge portion of the home buyer market with self-employed entrepreneurs. And obviously they want to tap into these entrepreneurs as well. Obviously you add your income as well, you add your rental income and all that stuff as well, but it is more challenging. We developed the concept of rent to buy, and then there are also installment sales. So often people come to me and they've got a nice chunk of deposit that they can put down, and when they find a seller that's willing that they can pay the property off over a period of time. Sometimes we have developments where a group or a developer owns quite a number of apartments, and then they are willing to sell properties on the rent to buy concept, as long as they get a huge amount of return on that. So I'm actually got a meeting now at 4:30 this afternoon with somebody that's got a portfolio of about 30 units, where they realize, I want to sell some of them on the traditional market. I want to sell some of them just that generates me cash flow. We had one development in Braamfontein where the developer got quite a good return, actually 12% per year on the cash flow. So they said, I've got an apartment, I will give a finance to buyers that want to buy there. They can pay me back over 15 years. We did a credit check, we did an affordability check on the buyer, and they were able to sign a rent to buy agreement with a deed of sale and a lease agreement and a structured spreadsheet how to pay back the money over 15 years. So there are quite often alternative finance solutions for self-employed people and employed people. You've got to find these properties. It's not easy to find them. And sometimes they come to me when they've already done the deal, but they don't know how to structure the legal side. And then I incorporate either an installment sale or a rent to buy for them. But it's difficult to find these properties. So the best is still to get your ducks in a row, make sure that your financials are ready, you pay yourself a salary, and then through that, hopefully you can convince the bank to take up to be able to buy a property and finance it. We also find that the banks are obviously more agreeable to give you property finance if you have a deposit. They call it the loan to value. The LTV improves because they don't see you that you borrow 100% from them. They like it when you have a 20% or a 30% deposit. You get an interest rate, and also the bank is a lot more at ease in lending you money because they know you've got some skin in the game as well. But for you, I would keep those two properties on my own name. I wouldn't go out now too much and mess around with transferring into a company or something like that, because the company again you'll have to go through the same hoops of buying a property on your own name, where you started your own business now, and they will ask you, if you buy on a different investment company, who's the person behind this? It's not like the company's got its own. It's not like it's like a Pick n Pay, which got its own balance sheet, and they can actually, the entire finance application can stand on the property company or that.
Because as you said, with the business owner, you still got to show that you can afford.
You are the jockey behind that, yeah.
Yeah.
Unless you
it means the same thing, basically.
Sorry?
It means the same thing, basically.
Exactly.
Doing it by yourself, to the person.
Yeah. So you get down to the same concept there. Yeah. So that's why it's make sure that your own almost like life or portfolio is sorted out when you go to the bank with a finance that is for a self-employed person, which is similar to a company or a trust in that structure.
Yeah.
And Tabaleng, from your side as well, make sure that you've got your will in place. Make sure that you've got insurance in place, that if something happens to you, that your home loans and your property finance is fully paid up. And maybe in a year or 2 or 3, you can actually leverage a bond against that, take up a second bond against those properties. Then you use that money to put down as a deposit for your next property. But again, the banks are now, they are able to pull your credit score, and they can see that 6 months ago you borrowed money from Absa again, and what happened to that money? It's the exposure that you have. So unfortunately, fortunately, maybe due to avoid reckless lending, they are able to track all your surety ships. They are able to track where you did borrow money, where you applied for a property finance as well, because every time you apply for credit, it shows as an inquiry against your credit score, and it degrades your credit score. So if you have too many inquiries, it looks like you are shopping around for debt all the time, and it also degrades your credit score. So be careful.
I actually saw that on this app that was advised. It's called ClearScore.
ClearScore as well.
Your whole life was laid out in front of you. Everything you did wrong. Yeah, as well. So
yeah, I always say that the credit score is like a glass jar. It's very easy to break it or damage it. You can see right through what goes in there. And
yeah.
Again, but it's very difficult to break it once you've got a crack in there or it's broken. You've got that information stays on your credit score for a very long time. And they go back on that credit score. And I always say, as an Afrikaans speaking person, I learned the big word propensity. Propensity, which means is that you do have a money, but you don't have really like keen on paying your accounts on time, because you've got a little lackadaisy about that. But if you can demonstrate that you're paying your accounts on time a little bit before that, a lot of people ask me, okay, I open a store account now to build up a credit score, and I paid off the first month. I said, no, you've got to build up that propensity record. You've got to pay every month just before the time when it's due. Pay maybe 100 Rand more. Then you build up a good credit score, but don't pay late. Don't damage your credit score. It takes very long to repair it again.
I was a lot younger when I missed out on a payment or 2, and it's still there.
Yeah. And also, even somebody came to me that was high in the property world. We assisted with property finance, and a Telkom account was mispaid for 2 months. Now, Telkom is not a credit account. It's just like your telephone account, and nobody uses a telephone account anymore because you got cell phones. But that made a dent into a bad red mark onto a. Yeah.
I've
So
got
there's a lot of
couple
things.
that I've worked
The main
on, but
thing is that you've got to gather knowledge. You've got to listen to what everybody has been saying. As Nigel said, go to the private property platforms, go to speak to Absa Miguel, listen to what he says. It's such a wealth of data that you're building up here and knowledge, Nigel. So
yes.
hopefully we can all contribute and learn from each other as well.
All right, guys, that was a fascinating conversation today. I really enjoyed, I like the legal and the financial and accounting side. I come from that background, so I really enjoy these kinds of conversations. But I think, Maya, your advice and guidance has been enormously helpful to both Matt and Jared. So we thank you, thank you from the bottom of our heart for your help. And guys, I mean, all of these different support services, platforms, the professionals, they are all part of the support that we give here at the EDPF Academy and the incubator. And with the help of Private Property, who sponsors this 50-day property challenge, I'm sure that at the end of it, we are going to have an enormous amount of people in the public who have joined forces with us and purchased their first property within this 50-day property challenge. So once again, Maya, thank you very much. Jared, thank you very much.
Thank you, guys.
It was a great session, and we hope to see everybody that's been watching us over the last couple of days. We hope to see you again tomorrow. Have a great day, everybody, and cheers.
Thank you, Nigel. Thank you, Maya.
Bye. Thanks. Nice meeting you all.
Thank you, Maya. Thank you,
Bye-bye.
Nigel.